QuickBooks Pro Plus Desktop 2022 OneNote presentation. Invoice created from check, created from purchase order. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, we're in the icon left-hand side, topic introduction 7180, invoice created from check, created from purchase order. Also take a look at the immersive reader tool, topic introductions in the text area too, same name, same number, but with transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well, topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, and give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're starting off with the home page screenshot. We went through the purchasing process in previous presentations, with the purchase order being a request for inventory, and then we received the inventory. As we entered the purchase order and the receipt of the inventory, we named the customer who we were purchasing the inventory specifically for, not because the person we're purchasing from, the vendor, needs to know that information, but because once we get the information, we can then turn around and bill that customer for the work that we have gotten or the invoices that we ordered. That's what we're going to do now. We're going to go to the creation of the invoice. So if we look at the trial balance, of course, we're going to be creating an invoice, which will have an impact on the accounts receivable. We're going to have the other side going to sales. We're going to have sales tax that will be impacted because we're selling inventory and it's a taxable for sales tax. And then we're going to have the inventory is going to be going down. The other side is going to be going to the cost of goods sold. If we go to the vendor section and we look at the purchase orders, we see some of these purchase orders we created, which is just a request for the inventory, but we put the customer on those requests so that we can follow it through, tracking it as we receive the inventory, then hopefully creating the invoice related to the same kind of documentation that we'll be following through. Here are the checks. We paid for the inventory with a check. So we created these checks. Here's one of those checks. You can see the billable items down below because we assigned a customer to it, which will help us to create the invoice now and not just put the amount for the cost, but because we're using items, it will put the actual price for the sales price, not the cost when we create the invoice. So we're going to make an Eric Music invoice, and because we put that billable item and tracked it through from the purchase order on through, it's going to say, hey, we've got this billable stuff. Do you want to add it to your invoice? We're going to say, yeah, we do. There's the two billable items. We're checking them off in the items area. That means inventory items typically, and our invoice is populated directly from that kind of linked connection. So we've got Eric Music, we've got our ELPs, which is the Epiphone Les Paul. We got 50 of them, and the Epiphone semi-hollow body, 40 of them. That totals out with the sales tax to $30,450. What's the impact on the financial statements? We know that the accounts receivable is going to go up by $30,450 because it's an invoice. We've got the sales going up by the $25,000 plus the $4,000, the $29,000, not including the sales tax. Sales tax payable going up by $1,450. The cost of goods sold going up by some amount that's not on the invoice, but is known by the system due to the tracking of the items. Inventory going down, and we'll also have the subledgers for inventory and accounts receivable tracking by unit and by customer. Here is the trial balance, the accounts that were been impacted, accounts receivable, sales, tax, or sales down here, and then we have the sales tax payable, and we've got the inventory is going to go down, the cost of goods sold. You can't quite see if we see it down here. There's the cost of goods sold also impacted. If we look at the subledger for the accounts receivable, we'll see the information on a customer by customer basis, and we'll see the impact for the customer by customer. Total of that form should match out to what is on the trial balance here, as you can see. Then we've got the inventory valuation summary, which is going to break out the inventory not just by dollar amount, but also by unit. This dollar amount should be matching out to what is on the trial balance as well. So here's going to be another check. This is a check. You can see that this item over here is billable, so we can create another invoice based on it, making the invoice for Music Stuff Store, which is the customer located on the bill, will then give us that pop-up. It's saying, hey, we got this stuff connected to it. Do you want to add that? And we're like, yeah, okay. Items, we're going to click that one off. It's going to populate the invoice then automatically. So we've got another invoice. This one's for 10 Gibson SG guitars at the 700. What's this going to do to the trial balance, to the accounts, to the financial statements? It's going to increase the accounts receivable by the total $8,158.50. The other side going to sales, but only for the $7,770. Sales tax payable going up by $388.50. Inventory going down by an amount not on the invoice, but known by the system, driven by the item. And the cost of goods sold is going to be going up for that same amount as the inventory going down. Also an impact on the subledgers for accounts receivable by customer, inventory by the units of inventory. Here is the trial balance. Once again, accounts affected, accounts receivable, sales, then the sales tax payable, then the inventory, and the cost of goods sold, which you can't quite see, which would be right under here. Here it is right there, cost of goods sold. The customer balance detail would also show the detail by customer, the ending point of the customer balance detail, 46,830, matching out to what is on the trial balance way up here, 46,830. Then we've got the inventory valuation summary, the 9,689 being the total, also breaking it out by unit. That should match out to what is on the trial balance as well. For the income statement, we have the sales impacted and the cost of goods sold impacted, the difference between the two being the impact on net income. Let's look at these from a journal entry type of standpoint and see what those invoices would be doing. If we made those invoices with just a journal entry, we would have the sales, which would be going up. That would be shown on the invoice. The sales tax is going to be 5% in our generic problem. That would increase the liability account. The accounts receivable, what we expect to receive then, would be the sum of those two, $30,450. Inventory would be going down by an amount that would be the cost that won't be shown on the invoice, but is known by the system if we're using a perpetual inventory system. Cost of goods sold going up. What's the impact then? We got the accounts receivable was at 8,222, went up by 30,450, debited to 38,672. Other side going to sales down here. So we got the accounts receivable and then the sales going up from 10,107 up by 29,000 to 39,107. So that's these two. Sales tax payable going up by 1,450 up to 1,955. Then cost of goods sold going up 8,062 starting point by 23,200 up to 31,262. The impact on net income is the sales minus the cost of goods sold, net increase of 5,800, and then of course the inventory is going down by the 23,200 to 15,678. Here's the detail with the GL, so you can see the general ledger was at 8,222 for the accounts receivable, up by 30,450 to 38,672. Sales tax was at 505, up by 1,450 to 1,955. Sales was at 10,107, up by 29,000 to 39,107. And then the cost of goods sold was at the 8,062, up by the 23,200 to 31,262. And the inventory was at 38,878, down by the 23,200 to 15,678. If we look at the subsidiary ledger related to the accounts receivable, we see that we had the change here of, I believe it was this one, Eric Music was at 0, went up by 30,450 to 30,450. If we sum up all the customers in our subledger, we get to the 38,672. That should match what's on the accounts receivable, 38,672. And then if we do the inventory, we have the inventory items. I'm not sure exactly which inventory items we purchased, but let's just check it out. We're going to take a look at it. It was on 123. So here's one of the items. We purchased an ELP or sold an ELP. We had 50 of them before. And if we had 55 before, if we sold 50 of them, we have 5 left at 402,000. If we add up all the inventory parts here in our subledger, that should add up to the 15,678, and that should match to what we have in our inventory GL, the 15,678. Let's do it one more time. So one more time, the second invoice had the sales price of the $7,770. We had the sales tax would be 5% of that. So that times the 5%, the accounts receivable, therefore $8,159. This would be basically what's shown on the invoice. What's not shown on the invoice is the inventory going down by the $5,980 and the cost of goods sold going up by the $5,980. If we post that out, accounts receivable goes up by the $38,609 to $46,830. The sales goes up by the $36,770 to the $46,877. The difference, the sales tax payable goes up from $1,839 to $2,344. Then the inventory is going to be going down. So inventory is going down to the $9,693. This is for both those transactions, by the way, are included in these entries numbers. And then the cost of goods sold is at the $46,877. Let's look at the GL to get a little bit more detail. Last time we were at the $38,672 for the accounts receivable, goes up by the $8,159 to $46,830. We were at, for the sales tax payable, with a $1,955 up by $389 to $2,344. Sales was at $39,107 up by $7,770 to $46,877. Cost of goods sold was at the $31,262 up by $5,980 to $37,242. Inventory was at the $15,678 down by the $5,980 to $9,698. If we look at the accounts receivable subledger, we have this detail for the receivable, which is up top, 8159. So 8159 is Music Stuff Store. It was at 0, went up by 8159 to 8159. If we add up all the subledger accounts for the customers, it ties out to the 46,830. That should tie out to up here, the 46,830 on the GL. And then we've got the inventory subledger, which I'm pointing all the way over here. We purchased one of these in the process, or we sold one of these. 10 units of the GSB unit. We had 9 before. We sold 10 of them somehow, so we're down a unit. So something kind of funny went on there. But if we add up then all of our inventory items, it's adding up to the 9698 in the subledger, and that should tie out then to the 9698 on the GL as well. So you can see how kind of tedious this is if you were to make all these reports basically from scratch, and see how, you know, QuickBooks makes the linking a lot faster, so you don't have to do all this other kind of work behind the scenes. But the fact that it's faster means you don't see all the work that's being done behind the scenes, and you lose track of what is actually happening and how everything ties together, and therefore how to read it, how to comprehend what you're looking at.